Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's podcast, we're diving into the abrupt shutdown of Pandion, a US-based parcel delivery startup that raised $41.5 million and seemed poised to disrupt the logistics space. This story reflects a breakdown of market dynamics, funding hurdles, strategic blind spots, and a few brutal truths that every founder needs to hear. Let's cover the story into 4 parts, followed by the lessons for the founders. Part 1. The Rise. Founded in 2020 by Scott Ruffin, a logistics veteran with prior stints at Amazon, Pandion was launched with an ambitious vision to modernize and scale parcel delivery using proprietary tech stack, integrated networks, and operational efficiencies. Think of it as a startup alternative to UPS or FedEx. During the COVID-19 e-commerce boom, online shopping was exploding. Demand for delivery services was off the charts. Pandion quickly raised capital and scaled operations. It leaned on a mix of last-mile partners, i.e. U.S. Postal Service, and gig workers to complete deliveries, thus keeping its model agile and asset-light. By 2024, Pandion secured $41.5 million in fresh funding, enabling the startup to deliver over 100,000 packages a day, with sales forecasted north of $200 million. However, as they say, speed works both ways. Rapid gains can also lead to equally rapid losses when conditions change. Part 2. Market shifts and cash crunches. By late 2024, the logistics landscape had changed, but not in Pandion's favor. The post-pandemic normalization of consumer behavior to offline meant that the sky-high growth in online shopping was tapering off. Giants like Amazon, FedEx, and UPS had sensed the market shift and already adapted and optimized for the new normal. However, Pandion was only structured for the online methods. Meanwhile, the startup faced increasing operational costs and loan obligations. Scaling infrastructure, managing partner networks, and staying competitive with razor-thin delivery margins was now a Herculean task. Without consistent volume growth, the cost became unsustainable, making it difficult for Pandion to stay afloat. And then came the funding winter. The broader venture capital funding tightened dramatically in 2024. Investors became risk-averse, and deals slowed down considerably. Pandion was desperately trying to raise further capital to survive. When fresh funding didn't materialize and acquisition talks fell through, Pandion had no financial runway left. On January 13, 2025, Pandion officially ceased operations. Due to our legal obligations to our lenders, our board of directors and I have decided that we must immediately shut down the company. Today is Pandion's last day as an operating business. We've already canceled inbound packages and will have no further pickups, Scott admitted. And just 2 days later, on January 15th, all employees were terminated. Part 3. Reasons behind the collapse. So, what really went wrong? Here were the 4 key drivers behind Pandion's collapse. A. Over-reliance on macro trends. Pandion rode the wave of pandemic-driven demand, but didn't build a business resilient enough to survive the market shift. Their model wasn't designed for a leaner, post-COVID world where customers expected lower prices, faster shipping, and a return to pre-pandemic behavior. B. Lack of competitive advantage. In a crowded field dominated by entrenched giants, Pandion never carved itself a distinct enough value proposition. Competing with Amazon in logistics was like trying to out-Google in the search market. Pandion was essentially playing catch-up with limited funding and resources. C. Capital-intensive model without deep pockets. Delivery isn't a SaaS platform, it's brutally operational and capital-heavy. Pandion tried to scale fast, but growth in this space leads to huge cash burn. And with limited funding sources and rising costs, sustainability took a massive hit. D. Failed exit strategy. While there were many conversations with potential acquirers, none of them panned out. Whether it was valuation mismatch, integration concerns, or just a plain cold feat, the acquisition talks failed. Part 4. The industry-wide wake-up call. Pandion's shutdown isn't a solo tragedy. Other delivery startups like Point Pickup and Mayergo too shut down in late 2024 or early 2025. The message is clear. Logistics startups are facing the double whammy of macroeconomic tightening and intense competitive pressure. At the macro level, e-commerce growth is slowing, and gig economy partners are now demanding more. Logistics costs are rising, from labor to fuel to compliance. It's deeply operationally intense and desires ruthless efficiency. Investors are now prioritizing profitability over fast, unsustainable growth, something many startups learned the hard way and failed. Jasa Rodeo now covers 50-plus podcasts on startup failures. You can now learn lessons from each. Finally, lessons for the founders. Here are the 5 brutal, yet essential lessons from Pandion's collapse. 1. Don't mistake a market boom for a business model. If your growth is tied too closely to a temporary trend, you must have a solid plan after the trend ends. Pandion scaled too quickly based on pandemic dynamics without building long-term resilience. 2. Differentiate or die. In legacy-dominated industries, better isn't good enough. Your startup needs to be radically different, whether through proprietary tech, go-to-market strategy, or customer niche. And Pandion wasn't distinctive enough to survive the tough competition from legacy players. 3. Runway is everything. Capital is oxygen, especially in operationally intensive businesses. And running out of cash is a death sentence. Limit your burn rate and always have backup plans. You can't continue to depend on funding to survive. 4. Plan for both growth and decline. Most founders plan for hypergrowth, while barely few prepare for market shift or contraction. Build lean and agile systems that can scale down as well as up. 5. Transparency and team communication matter. Ruffin took personal responsibility for the abrupt shutdown, but the team reportedly had little warning on terminations. If things are going south, communicate early and more, even if it's uncomfortable. Your team and investors deserve that. The story of Pandion is not just about a failed delivery startup. It's a case study in how tough markets, flawed assumptions, and missed red flags can bring down even a well-funded venture. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.